Thank you. Thank you. Let me start by thanking you for inviting me to this session. And I'm going to share, I have some 3 slides. I have some 3 slides, and I would like to share my slides so that at least they can be seen, because there are 3, so it means that I'm going to move with speed in terms of what I'm going to make a presentation on. And I hope you can you manage to see the screens, please?
Yes.
Okay. Oh, sorry, I want to make sure that they are all. Okay. Very good. I think I was told to talk about this fintech revolution. And because I like the subject matter is because of where I'm coming from. I thought maybe the first thing I do is that I will talk about where is fintechs, where in the last 20 years, what has happened to the fintechs? And the second thing is that what kind of results are we seeing fintechs driving in the marketplace? And the final point is that coming from being a regulator, I also find maybe I have to talk about the issue of, do we need to regulate fintechs? Because there's a lot of literature and debate about regulating fintechs. But first of all, let me tell you, I work for the African Economic Research Consortium. Our approach to capacity building and knowledge generation is very, very critical. I have to share this slide so that I don't lose my job, but that's very, very important. But then we come to the main issues. In the last 20 years, what have we seen? We have seen that the fintechs have changed the way banking services are provided, and especially in the African economies, where the informality of markets is such that it's so difficult for you to access the banking services. The way banks work has also changed, because all of a sudden the banks realize that they have technological platforms they can use. And I'm very happy because all this related to like the M-Pesa developments, and Nick will perhaps talk about it, being one of the one of the main originators of M-Pesa. And secondly, even in terms of the applications he has done. And also we have seen even how capital is raised has changed. And even our knowledge of money and its form has changed. Like everybody was astounded when M-Pesa started using electronic units of money and using it to transact. And everybody thought that it was a new institution issuing money in Kenya, other than the central bank. And it's because we didn't have knowledge in terms of how different forms of money can work, yet they were still fiat organized or issued by one institution called the central bank. And so we have seen the rise of mobile money, or what people would like to call electronic units of money. And the second thing that has become very important is that most of these fintechs have actually originated from a regulatory sandbox. And this allowed regulators to support fintechs in terms of product development. And M-Pesa is an important case in point, even though when M-Pesa was starting, nobody talked about regulatory sandbox. It is because of its success, everybody started saying, how did you nurture it? How did the originators or even the developers originate it? How did the regulators deal with it? And we have seen the first impact was to revolutionize how retail electronic payments and even digital financial services was working. And for us, that's a very, very major contribution in terms of this area. The second point I wanted to make is, what are the outcomes? It's a success story, all right, but what are the outcomes? I want to give 4 outcomes here. One of them is the retail electronic payments platform evolved. The most important point, and you see the area literature, was that it was being described as effective, efficient, transparent, and safe. But for us, especially coming from the African region, it's a very easy entry into financial services. And more importantly, because we have so many informal markets in Africa, it was an indirect way of formalizing informal markets. But the most important point I want to make here is that once you have a successful electronic payment system or even platform, it becomes a game changer. And fintechs can roll out new products that will affect across all sectors of the economy. And we're going to see examples. The second thing is that financial inclusion was always something that had evaded the African continent, because banks were in cities. Banks were in major towns. You have really to get there. But it is because the banking sector itself had not realized that they can use such a platform to actually develop aspects of financial inclusion. So we have seen that financial inclusion has been a success, and there is evidence now of financial development, but more importantly, inclusive finance and poverty reduction. Banks recognize that they have a technological platform to manage to use so that they can manage micro accounts. You don't have to visit a bank. You can actually transact in your comfort, in your home comfort. They would reach customers cost effectively. It has also, especially for me coming from the central bank as a regulator, it allowed me, and I argued this very strongly when I was defending Kenya when it was in the dark gray list by FTF, that it is going to improve the AML CFT regime because electronic payments are monitorable and financial transactions can be monitored, so they can improve the AML CFT regime. But more importantly, it is inclusive finance that is going to be important for us. And we have seen cases where women can save in instruments that cannot be encroached. They are efficient savers. And these are very, very important outcomes from a developmental or even inclusive growth point of view.
Governor, I'm sorry, can I interrupt you? Just, I don't know if you want to advance your slides at all while you're going through.
I haven't moved them. Okay, let me mention this last point and then I'll move the slides. Yeah?
Perfect, thank you.
They're not moving? Okay, I found, are they moving?
No.
Okay. Okay, let's see how I can then move them. What about now?
Nope, I think we're still on your home slide.
Oh, okay, then there must be some problem I tested this and it was working. What about now?
No, unfortunately, they seem.
Okay, let me finish, then I'll share the slide. Okay, yeah. Let me press on. And I tested it and then I saw them moving. But you want me to start over again? Let me see. Let me say that fintechs have rolled out sustainable business models, and we have the examples. For example, the 1 acre fund that has raised productivity of incomes from smallholders. M-Copper on domestic solar energy has really become a very important source of writing and even energy supply in countries where this is quite a constraint, or cities where this is a constraint. Water vending machines in urban slums, crop insurance models, those are very, very important, including virtual health insurance models. So there are so many products that are coming in, including Emma Kiba, which you can invest in government securities using your mobile phone. But the final one, and more important, is that we are revolutionizing e-government services, electronic government services, tax policy designs, tax payment platforms, and even revenue administration. For me, the design of efficient social protection program, especially during the COVID, is really a game changer, showing how fintechs have really improved the situation for us. But finally, let me ask the question, have fintechs created any regulatory upheaval? And I think there are so many concerns whenever you turn and you find out that perhaps there is a major problem that we don't seem to realize. But when you look at it more deeply, then you realize that we don't seem to know where there are areas of concern that require fintech regulation. For example, in the financial system regulation, fintechs have not affected prudential safeguards or even consumer protection or market integrity. So there are no, the aspects of licensing digital banks is actually just the normal regulatory requirement. The most active areas where we are seeing fintechs being, or even an idea of regulation, is how to develop innovation hubs, regulatory sandboxes, and accelerators. But so far, the only area that I've seen in the literature that requires concern is actually consumer and data protection, which for me is an operational resilience. And the most important aspect of these regulations or discussions in these regulations is actually to minimize regulatory arbitrage, because fintechs will be regulated by different regulators, and how do they come together? For me, the final point I would make here is that it's an argument of prudence that is required. We would like to make sure that we don't discourage innovation and even investment in this area. We want to promote financial stability and market integrity. So what kind of actions do we take to combat any emerging risk as soon as they are recognized is going to be very, very important, and also create an element of coordination and cooperation across regulators. In that way, we can actually gain the advantages of what we are seeing, the fintech evolution coming into the market across all sectors of the economy, and we are sure to make a very good case in the future. It's left for me to say in our language, asante sana, that is, thank you very much in Swahili, and then I will discover why the slides didn't move. Let's see, am I back there?
Thank you so much. Well, even without...
I'll share the slides. I'm sorry about this because when I tested, it worked very well. Now I'm not so sure.
Well, it would be great. Yes, maybe we can share them with the audience later, but thank you. Those remarks were very helpful in kicking us off. With that, we'll move to the next presentation, Nick Hughes.
Great, thanks. It's a pleasure to be here. Thank you for inviting me. And it's always good to follow the governor of the central bank. You know, I was thinking the other day, M-Pesa is now 14 years old. So it's a little bit like a teenager. It's quite big. You know, it's doing lots of things. It's very active, but it's still a relatively young thing. And I know we still talk about it a lot in an African fintech context. But it's, it's obviously very successful in one country. But I'd like to talk a little bit about a framework for how I can see fintech applying more broadly, and how I think the technology is starting to allow us to explore new business models around fintech, not just strictly payment services. So I'll talk about that for a few minutes, and then I'll sort of end with a little bit of research that we're doing at London Business School around scale, because scale is quite an important issue here. We sort of hold on to scale all the time, and M-Pesa, of course, by whatever measure you take, has scaled very well. But there's some data starting to emerge that hitting scale is actually quite hard, and I'd like to touch on that if I can at the end of my presentation. So let me see if I can share my slides, and I hope, can you, perhaps somebody could confirm if they can see my slides?
Yes.
Yep. Okay.
Can see them.
Very good. Thank you. I'll try that. Let's see if I can get off the first slide and see if it moves. I only have two to share, actually. This first one is a very simple framework that I use when I'm talking about mobile payments and where I believe innovation is starting to happen. But basically, I believe there are two very powerful levers that we've got now that we can use. The first, of course, is the GSM infrastructure. Now globally, 93% of the world's population are now under a mobile network somewhere. And that could be a 2.5G network. It might be a sort of a 4G network or an LTE network where we're starting to see, great improvements in what we can do on those networks. And this infrastructure layer is very powerful, I think. And you can couple that with the fact that smartphones are now relatively cheap. I mean, you can get a smartphone in many parts of Africa now for under $40. And so you've got an amazing device in your hand and a good quality network. And there are perhaps some issues around the cost of data and usage of that network. But generally, we have this fantastic infrastructure layer that we can use now when we think about designing new products. And on top of it, of course, payments, the ability, because of the regulators having moved this way, we can now move small amounts of money between accounts at a pretty low cost, and obviously over great distances. And that payments layer, which M-Pesa started in 2007 when we launched it, has actually evolved into something much more now. Individuals can move money between people, you can pay your bills, businesses can do bulk payments or disbursements. And so that itself has evolved quite a long way. But for me, the most exciting part is around the services we can build using those two layers. And M-Copa is a good example. So at M-Copa, we provide clean energy services to people who are off-grid. And so you start, hang on a minute, what does energy services got to do with payments? But actually, the business model that M-Copa has adopted, and many others now in this space, has been made possible because of those first two layers. First of all, we can connect to the solar equipment. So that's a solar panel and a battery and a TV and a radio and lights. We can connect it and see it remotely because of the infrastructure layer. And because I can collect a small payments, I can turn it on and turn it off, and I can allow the customer to buy it in small payments. And so I'm financing a consumer or a household or a small business, when I'm financing their way into clean energy. And then Copa's now got over 1 million customers in East Africa. But for me, that's just one example of where I think digital payments need to go. We need to think about the opportunities to change the business models in other services, so adjacent sectors, services and agriculture. And the governor mentioned a couple of other great examples of using digital payments in the ag sector space. So for me, this is very exciting. You know, I think we're going to see more and more innovation around embedded financial services, utilizing those two big levers of infrastructure and digital payments. So that's the sort of high level position. I'd like to show you my next slide, which is sort of brings it back to earth a little bit with a bump, because it's actually quite hard to make things scale. And so we've been doing a little bit of work at London Business School with the Wheeler Institute for Business and Development, with some FCDO support, so some government, UK government support. And we've pored over the data of around 700 fintech companies, trying to look very hard for good evidence of scale. And it's actually a harder thing to do than you might think at the outset, because first of all, fintech isn't one thing. And many of people listening to this will know that. You know, you can't take a look at fintech and do any sort of decent analysis without breaking it into the different elements of fintech. So you've obviously got infrastructure plays, you've got payment services, you've got small sort of crypto type applications which get bundled in with fintech as well. So the first thing to do is to understand what do we actually mean by fintech, and then disaggregate data down at a firm level, down into those different types of companies offering different types of fintech services. And then you start to bump up, well, what do you mean by scale? Is it the number of customers or users? Is it the revenue? Is it the number of employees? And so we've looking at these data, we applied a very simple index rule across 4 characteristics of scale, which is shown on the slide there. So certainly number of users, that's probably the most common one. But we also tried very hard to get good data on revenues, the amount of fundraising that a company has done, and the number of employees working in that organization. And that allowed us to create an index, and we could move an index towards a score. And what we're finding is actually only around 8% of the companies, of the 700 fintechs that we looked at, have reached scale if we use that cumulative index score that you can see there on the slide. And that's actually a little bit lower than we might all think. When we think of fintech in Africa, we think fast-moving, nascent sector, fast growing, lots of opportunity because of all the infrastructure problems we see in many parts of Africa. And so I think we'd expect to see more scale than we actually can when we get deep into the data. You know, and then I'm reminded of my own lessons, you know, as we got M-Pesa going, as we grew M-Copa, it's actually very hard operationally to hit scale. And there are a number of reasons why, but I'll just share a few, and perhaps we can come back to this in the discussion. First of all, Africa isn't one place. Of course it's not. It's hugely fragmented. And back to the governor's point, we need to see more coordination across the regulators to allow us business practitioners to play by a common set of rules and know how to invest and where to invest, with some regulatory certainty around some key points behind running a fintech business. Secondly, we shouldn't lose sight of the fact that there's still a need for a cash to e-money interface. That's really important, and it's often forgotten about when we talk about fintech. We imagine everything is going to be purely electronic, and we're going to be able to move information and value around without the need to turn it back into cash. Actually, that's very hard to do. And in many parts of Africa, we still need to think about how we get cash into electronic systems and electronic value back into cash. And that inevitably takes you towards the need for agent networks. And agent networks are complex, and they're big, and they're quite expensive to run. And so that's, you know, my second point is we've actually still got to keep our feet on the ground and remember we still live largely in a cash economy in many parts of Africa. So so I'll wrap it up there, really. I mean, the first, I hope I gave you my view of a framework, which I'm very excited about, and I am an optimist around the potential for fintech in Africa, as you'd expect. But equally, on the other side of that coin, we've got to remember it's not as easy as we think. It's actually pretty hard to make this stuff reach scale. And I look forward to any questions on this presentation and the discussion with the other panelists coming up soon. Thank you.
Great. Thank you so much, Nick. That was wonderful. Okay. Next up, we have Viola Llewellyn for her presentation.
Hello, everybody. Let me just get myself set up here really quickly. Okay. Have I got it correctly?
Yep, looks good.
Thank you. Good day to everybody. I'm so excited to be here with the University of Michigan and all of these great panelists. My name is Viola Llewellyn, and I'm the co-founder and president of Avamba Solutions, Inc., which is a trade tech solution that innovates for banks, central banks, SMEs, and those that wish to serve Africa's SMEs and those in the informal space. And I'm going to be talking to you about the context of fintech in Africa from the context of trade. Ovamba's always sat in a very strange place that I think helps to make meaning of what are we doing with all of these wonderful fintech payment solutions, and how does that impact us as a continent? We are involved and are always concerned with better ways in which to build risk models to understand SMEs and the informal sector within the African cultural context of trade. And for us, fintech is really about opening up the door and making sure that every individual on our continent who wishes to engage either domestically or internationally has the underpinnings of an ecosystem that will support growth, wealth, and a clear understanding of who we are as people and as part of a larger global community. By having products and systems and solutions and innovations that drive visibility, we can start to understand what exactly is needed for every individual or every business owner who wishes to develop transferable wealth. Before this point, it was very difficult to see exactly what is happening in the far reaches of any economy, especially those who are informal, especially those who haven't had the ability to gain access to digital currencies. Now, East Africa has been brilliant at driving that, but in the Francophone zone, that's a little bit different and doesn't look or even feel the same. We're in a very early part of developing the policies and the regulatory environment that will allow that great explosion that we are all expecting. Now, because of fintech, the words and the language around Africa is open for business, we can kind of put that away. Fintech connects our old selves to our future selves as digital citizens who are involved in the movement of cash and services. Our old self as Africans, we traded, we created a lot of transferable wealth. And now we've come full circle where we can finally say, fintech is how we answer the questions of what are we buying? Where are we buying it from? How is that information being moved up into the policy area to make decisions and support fintech innovators as we impact the ecosystem? We've got to be able to continue answering some really simple questions. When we ask the question about where is the cash, we're really talking about traceability, trackability, innovators who are helping us to understand what, not just what happened, but what is supposed to happen, using AI to model outcomes so that policymakers can help support a healthy economy, understanding why it is that one cultural group is better or different or operates with success in a different way. For us, using trade to understand that is a great way to support the economy, a great way to support Africa in the dawn of the African Continental Free Trade Agreement, which is going to turn our continent into the biggest trade zone in the world. Without fintech solutions that have entrenched themselves before this point, we would be doing what Africa is always known for, waiting to leapfrog. Now, the context with the African Continental Free Trade Agreement means that we can lead. Providing options to access to capital means that we're supporting that whole democracy of access to capital, which is the same as the democracy of deciding how successful an individual wants to be. It's not for us easy to talk about fintech without understanding the human journey in this. We often talk about those who jump into this sector because they think it's the right thing to do. After all, Africa is known for emulation and leapfrogging, but we've gratefully left the point of innovating for innovation's sake just because that's what everybody else is doing, because so many of the best players in our industry have given us the ability to ask the right questions so that we can create the best solutions for the challenges that we see. But in building these, we need to be sure that we don't create additional forms of digital poverty, all the way down to childhood or even at birth, when the need for electronic IDs will start to become absolutely normal. And that's when fintech and other attending solutions allow us to do cross-border trade with each other, which means that banks will have to work with the regulator for things such as interoperability, making sure that finance, cash, capital is tracked, it's traced, that exchange rates, liquidity, foreign exchange is all automated or easily understood. One of the things about Africa's context that I really have to push against, especially when speaking with VCs, is that not all solutions for Africa are purely digital. We still have analog and physical ecosystem challenges that we have to navigate. For example, in minding the gap and ensuring that the ecosystem can support economic growth, we have to make sure that laws and other legal considerations are interoperable with what policy is now, knowing full well that we have to support policymakers because they are often behind innovation. And until these two can line up a little better, we're always going to be doing two things at the same time within the African context of fintech development. And those two things are explaining and trying to get regulators to reduce that level of risk that they so naturally gravitate to, and making sure that future policy is actually built in such a way that it engages and promotes growth versus limiting and protecting while they take time to understand what we're doing. And it is definitely, hey Google, stop. Fintech and technology, what are you going to do? Anyway, as I was saying, it gives us an opportunity to design a future that connects us to the past. As traders, as merchants, as globally engaged, we can do that, but so much faster. We do that by ensuring that the velocity of capital is easily recorded and understood, that access and options are geared towards the real requirements of those that are driving GDP and the industries. And we make sure that the ecosystem itself can be sure that every African business owner or customer can decide and design a lifestyle that ensures that capital is accessible, it's accountable, it can be transferred, and that generational wealth becomes something that Africans are very comfortable talking about. For us, fintech actually impacts every part of our existence. We are technical beings. We are financially adept. We have a lot of products we want to create, manufacture, sell, distribute. And we need to also make sure that when we go out there and say we're doing cross-border trade with each other, that it is done so correctly that we don't push ourselves backwards to reinvent the wheel because we missed out on the best elements of what fintech can deliver to us as human beings and as global citizens. Now, I promised myself I would not use all of my 10 minutes, but I really do look forward to answering questions for anybody who wants to understand how we use this to create a new narrative and why an industry that is worth maybe $5.2 trillion and how we as Africans can access that and be very responsible with the non-African partners that we choose to engage as we innovate and build growth. So I'm really excited to be here and to hear the rest of the conference and answer any questions. I hope that was okay.
Wonderful. Thank you so much, Viola. And I see some people are already starting to put questions in the Q&A. Some of the panelists are answering directly, but we'll also keep some of those for the Q&A session. So as you have questions, feel free to populate those in the Q&A and we'll address those during that part of the presentation. Now, last but not least, we've got Kunle up to make his presentation. Oh, you're on mute, Kunle.
You see my presentation?
We did, and then it went away. Why don't you try sharing one more time?
Okay.
There we go.
You good?
Yes, thank you.
Okay, good morning for me, good day for everyone else. My name is Kunle Olukotan, and I'm a professor at Stanford and also the chief technologist of Migo Money. And it's a pleasure to be here and participate in this panel. So thank you for inviting me. So I'm a core technology person. I've been doing technology for a long time. And so the focus of our approach to fintech was technology driven. And that's the way we went into a startup that was founded based on some AI processing technology that we developed in my lab about 6 or 7 years ago. And then, of course, you go into the market with technology, and then you're faced with the realities of actually doing business and doing business in Nigeria and Africa. And of course, that kind of changes your view of how far technology can take you. So let me tell you a little bit about what we've developed at Migo. The whole goal was to try and address this access to credit gap that we have in developing countries, right? So an estimate by McKinsey in Africa is over $500 billion of people who could small businesses and consumers who could use credit to drive economic development. And so if you could provide this credit, then of course, as we've seen in more advanced countries, that can drive a huge amount of economic development. And so we thought, well, can we use technology that we've developed to help this process? And so if you look at sort of what the situation is in Nigeria and other African countries, right, there's a huge number of barriers to actually delivering credit. So, the core issue is, of course, is the ability to assess the credit risk of the consumers, right? So there's no formal credit scoring models. There's no FICO system. The limited amount of data that exists in the credit bureaus just focuses on the very top of the income pyramid and doesn't really focus on the large number of people who could really need the credit. And even if you look at Nigeria, which has a large fraction of its populace who's banked, and they've got a banking verification number, even this penetration is not as great as you might hope. There's also a limited appetite for consumer credit risk when it comes to banking, right? So banks in Nigeria, have money that they'd like to, of course, lend, but they're lending it just again to the top of the income pyramid, or they're using the money to buy treasury bills. And even though the government regulators would like them to lend more, they have difficulty doing this. And the governor's comments about the regulatory infrastructure are really important, and I think others have mentioned. Regulatory risks affect what one can do. For example, M-Pesa has been tremendously successful in Kenya and around East Africa. But it thrived because of the regulatory structure that allowed a government-backed telco, Safaricom, to push mobile money and make mobile money successful. Mobile money hasn't been nearly as successful in Nigeria because we have a different regulatory environment where the banks are very powerful. The banks have 40 to 50% penetration in the economy, and they saw the telcos, which were foreign owned, as entering in, as a being incursing into their financial market, and so they weren't eager for this to happen. And the regulators, the central bank, basically, didn't allow mobile money to take off. And then there's the consumer technology limitations. People have mentioned that that there is this GSM network, but the smartphone penetration, at least in Nigeria, is only 10 to 20%. And so any technology that requires you to use a smartphone has limitations. And then lastly, there's this business and technology limitations associated with the fact that traditional financial institutions don't have the technology and human capital required to distribute service and consumer credit at scale. And then, of course, the existing network isn't always reliable. So MiGo is basically focusing on removing these barriers to credit, right? So the core one, of course, is the ability to assess credit risk by using AI and machine learning techniques to analyze huge amounts of data from telcos and other business to consumer businesses to train these models that can assess credit risk and make instant lending decisions. And then for banks that have limited appetite for consumer credit risk, initially, MiGo had to kind of demonstrate that these models actually work by lending their own money or guaranteeing the banks a fixed rate of return. And then, of course, we would make more return by directly lending to consumers. We already talked about the regulatory lists, but one of the key ones was the fact that mobile money really didn't exist. And so in order to lend to consumers and be part of the financial system, we had to be a bank. So we had to actually go buy a bank and prove this out. And then we stayed within the regulatory rails. Of course, banks give out loans and they participate in the financial system. And so you could think of MiGo then as being this link between large businesses like telcos and the financial system. In terms of the consumer technology limitation, the key thing was to meet the consumers where they are, right? So many consumers had feature phones, and so the initial service was provided on USSD, which of course allowed the large number of consumers with feature phones to use it, but it was also possible to access the credit service through the web, through banks' particular apps, and even at ATMs. Of course, cash is still widely used in much of Africa, so you need some way of getting money. In towns, there are ATMs. Further afield, then, of course, there's the issue of the agent network. And then lastly, the business technology limitations. And this is a place where MiGo's capability was to provide a service with simple APIs that could be integrated into businesses and banks' technology platform, and provide this capability for providing credit by providing both the scoring, the decisioning, the servicing, and the collections. And so the kind of two key products that MiGo provides. First, origination, right? We provide scores, and we integrate with AppZone, which is one of the leading providers of software solutions to fintechs and microfinance banks in Nigeria. And using this scoring capability, we can get very accurate models for first-time lenders and the lifetime revenue from lenders. And we use all kinds of information, telco information, also data from the macroeconomic world, such as economic indicators and currency fluctuations. And the prediction rates are very high. And then, of course, we also do the servicing of loans. So we have different kinds of loan products, bullet one-time payment loans and then installment loans, and these can be arranged to provide services, credit service, credit products to users in different ways, right? So you can provide direct cash loans, or you can provide you can provide money payments to merchants. And so Migo powers both of these, and these two different products provide a way of cash for the consumer to use their data use the money directly to do whatever they want, or money to be used as the purchase of goods, so credit at the point of sale. A key point I'd like to make about Migo's approach is really about partnerships, building partnerships between different businesses to provide the consumer credit services that we provide. So merchants, of course, have the consumers, and also the need for credit to drive their business, such as power or pharmacy or medicine or all sorts of things that you might want to get, services, food, tickets, what the like. Telcos also have consumers, and they've got the communication network and the ability to have data that can be used for making credit decisions. The payment platforms are the rails that provide the financial connectivity to move the money around, and of course the banks that provide both the lending capability and the money that drives the whole system. And so making partnerships between these different stakeholders means that everybody has to have a piece of the action, right? So you've got a complex deal structure, and to make everything work, people have to feel, the different companies have to feel like it's a worthwhile activity. So the results have been quite exciting, right? So we were able to provide credit to small businesses and consumers, many more applicants, of course, than we can service, because, of course, they're not all don't provide the credit worthiness that we would hope. But still, over 2+ million borrowers. Examples here from Fumilayo and Marcus on how the availability of credit has really enabled them to improve their businesses. So lastly, we point out that, I'm just the technologist. The key driver to Migo is the CEO, Akechi Nwaka. Other people who are important are the data science, VP of Data Engineering, Tevye, and the Managing Director of Nigeria, Winston Osuchukwu. We have a global organization. The data science and executive is in San Francisco. We've got, of course, operations in Nigeria, and starting to ramp up operations in Brazil, and then we do some back office work in Poland. So lastly, let me say that the key takeaways is, Migo is really this embedded lending platform that enables companies to extend credit to consumers and small businesses in their own apps. It's the partnership model. We're not coming over directly to the consumer with an app on a smartphone. We want to partner with people that this steers clear of the regulatory risks of the banking environment, and ensures that we've got lots of people who want to participate and are excited about our success. And so key to the whole approach is, of course, sophisticated ML algorithms that assess credit risk using company data, and then the ability to automate both the origination and the servicing of credit. So I'd be glad to answer questions in the Q&A. Thank you very much.
Wonderful. Thank you. Thank you all. I'm struck by the diversity of topics we've covered so far, and I see some even more topics popping up in the Q&A. And it's striking to me that although we've talked about the diversity of the African context, right, and how Africa is not one place, But still there are these themes that persist around Africa and indeed around the world when we talk about regulatory coordination, when we talk about access to credit, when we talk about cybersecurity, things like that. So we're going to dive more into that with the Q&A. I encourage audience members to continue to put questions into the Q&A. We've got just under 30 minutes to try and get to as many of those as possible. We also have some other questions that came in previously for the panelists. So while we've got maybe some more questions popping up in the Q&A, why don't I just start with some of the previous questions that we had, and Governor, if it's okay, I'll start with you. In the last decade, we saw the Central Bank of Kenya make a key decision to issue a letter of no opposition early in the development of M-Pesa's mobile money system, and we've all talked about that quite a bit. Given the central bank's role then, how do you view the role of the central bank in the next decade as we think about balancing innovation and consumer protection?
Thank you. Thank you very much. That's a fantastic question. And one of the things that the Central Bank of Kenya did at the time is actually to study the products that are coming to the market and also study the terrain in the market, because essentially M-Pesa was a product everybody thought it was just a transactions platform, but nobody saw it that it was actually going to be a very strong instrument of financial inclusion. Now, we have covered quite a bit of space in terms of financial inclusion, and most of the African countries are joining in doing so many things in terms of the financial side. And that's where central bank really in. But looking at it from the very end is to see what are the benefits. And I like Professor Conway actually mentioned why Nigeria. I've visited Nigeria twice to talk about why we need mobile phone financial services. And I can tell your answer is about the strength of the banks. And I had to fight with banks myself. If you look at it today in terms of how banks have managed to navigate and to use that platform, electronic payments platform, or even even M-Pesa, and even to actually cover so much of the market, then you see that the future development is such that what we really need in the future. One of them is that we are likely to have digital, just branchless banks, because essentially you don't even need to take a long trip to the bank these days. That's one aspect. The other aspect is that if we move away from the current conditions of the COVID, actually economic vibrancy can be driven by that kind of aspects. And this is where the central bank can move in that direction, try and consolidate the gains. When I talked about the last 20 years, what we have seen in terms of fintechs and even the space and financial inclusion since the introduction of M-Pesa, you can see that we are unlikely to go back where we were 14 years ago. As Nick reminded me, it's only 14 years ago that M-Pesa has been. And most countries are aspiring to be where we are. But what do they need to do? What was financial inclusion for? Yes, it means we need to move further and say, what about financial development? How about getting to capturing all the markets? I think I made a comment that we have seen that fintechs are coming up with products that are actually sustainable business models that are cutting across all the sectors of the economy. So in a sense, here we are seeing that this is the tail that is going to wag the dog. And that is for us a developmental discourse that we cannot shy away from. And this is where I like most in terms of the future. We should encourage this, but let's not worry about regulatory problems, because as long as you know exactly what is happening in the market, you can actually safeguard that. And the technology of regulatory sandbox is still live and very, very active. So I do believe that we can move mountains in terms of the development discourse of our countries. And the final point is, I talked about informal markets, and look at Africa today, you'll find that there are two aspects of the markets. They are informal, but they are also segmented. And it's so difficult to navigate through different segments of the market. And all of a sudden, these electronic payments platforms, including e-government, has found many countries, especially in the East African region, navigating across segments of the market. And for me, that is very, very important. Thank you very much.
Thank you so much, Governor. And Nick, you wanted to weigh in here as well.
Yeah, please, if you don't mind. Yeah, just to build on what the governor said, I think if we look to the east, we could actually got some interesting market developments that we could look at and learn from. There's the India stack, so-called in India, and of course, you know, it's you've got a much more centralized top-down control system there across the whole of India. Even though India, of course, itself is also super fragmented, but by putting the UPI in place, concentrating on digital identity, these are really strong building blocks that I think we'll need to see them emerge in Africa too, and across Africa, to allow those next layers of services to be created. But I do think there's some lessons from, you know, other parts of the world that we could look at that have worked well. And for me, digital identity is going to be a really important feature of a scaled out system in the future.
Can I say something here?
Sure, please.
Yeah, so I think you know, I exactly agree with Nick that digital identity is one of the key elements that we needed to solve in the Nigerian context. Was, you know, we already had this bank verification number that was associated with everybody who used the banking system, right? And what we needed to do was connect that with the mobile phone identity. And then once you made that connection and you had the KYC information and you could check that out, then that became the way that you could authenticate the users of the system, right? And so, you know, I think it's key. You've got to have some way of figuring out who people are and what they're associating with the financial system is. And so I completely agree with what Nick had to say.
Great. Well, we've got lots of questions popping up in the Q&A. One, I think Kunle and Nick would love to get your sense on. One, this one was there any venture capital for Migo or for the other fintech mobile tech providers? Was the VC, to the extent you were VC funded, sourced in Africa? If so, where? If not, from where else? And how many serial entrepreneurs can be found in Africa today? I guess let's think about this as like a broader question about VC in Africa and where, you know, VC funding comes from and maybe how we can think about that ecosystem. Yeah,
it's a really important question. You know, if you look at the number of entrepreneurs that have in this whole digital fintech space, it's mushrooming, right? You know, go to Kenya, South Africa, Nigeria. There are lots of entrepreneurs who are doing interesting things, and I think there is a lack of VC capital to fund a lot of these interesting ideas. I think that's an area where we could use more investment. A lot of the investment is coming from the US and Europe. And most of the people who get money from these environments tend not to be African, right? Even though they may be doing business in Africa. Now, I'm an African who lives in the Valley, right? So I'm kind of in a unique position, and so I was able to raise money both in the U.S. In some of it from Africa, from Nigeria, and some of it from the UK, right? And so, but I'm a special case. Yeah.
Nick, do you have thoughts here you want to add?
Yeah, can I just say, Adrian, it would be remiss for us, and Kunle, thank you, your comments are very correct. Just like you, Cameroonian parents, born in London, I live in Maryland. And raising capital for Ovamba with my business partners, the VC space is very keen to do two things which I think don't fit, at least back then. First, they want to be able to quote unquote help Africans, but they want whatever is supposed to be disruptive to look like what they know. That does not always work when it comes to innovation for our continent. And it's one of the reasons why when we were raising capital, it was particularly difficult as a woman. It's not the same outcome for women raising capital for a tech company as it is for a male, even though similar to yourself, Kunle, I'm over here, I'm raising capital, In fact, if you saw the Digital Undivided report, at one point in the United States alone, they only could find 13 Black women to have ever raised VC capital for their own tech firms in excess of $1 million. I was number 12. It gets harder and harder, strangely enough, the more innovative and adventurous you get at knowing how to encapsulate Africa's problems. When you sit down and speak to VCs who don't know the continent very well, they have a perspective that has to be disrupted. Thank goodness everybody on this panel and University of Michigan, you guys do a lot to chip away at that. But raising capital for African startups and technology firms can sometimes come with strings that can subvert the purpose of innovation and your business outcomes. And sometimes it can be helpful. I think as African innovators, we're getting better at saying exactly what we mean and asking for what we want. So I just had to add that.
Absolutely. It's a really important point. Thank you.
Yeah, good points. And I was just going to put in a couple of data points which the audience might be interested in. We see into the fintech space around $1 billion was raised in VC in 2019. So slightly old data, but $1 billion. I mean, that's, you know, it's starting to get sizable. And I know from my own experience, you know, we raised money into, and COPA, of course, from a blend of organizations, you know, dotted all over the world, to be honest. But going back even further, M-Pesa only started because we had a grant really from the UK government, which allowed us to experiment and discover the model before it sort of got invested in heavily by Safaricom and Vodafone. But it's, yeah, it's a hard job raising finance. I do think there's been a change in the last few years where there are organizations very focused on that blended finance, where they want to see development benefits, general economic growth, and, you know, social and even environmental benefits accruing for their investments. And there's a lot more of that type of impact investment money around these days. And, you know, I think it plays an important role, especially in those very early stage ventures that we've been discussing a little bit today.
Nick, you make a very good point, and I'm sorry if I'm jumping in ahead of anybody else. When you think about how much capital is reported as coming into fintech investments, the numbers look great. But there are so many gaps where that capital doesn't trickle down to other types of fintech developers. But if there is ever going to be a change in the way in which we create valuations for African fintech companies, I think they should take into account those that don't get access to as much money, but are still able to develop growth. And I think that there will come a point in the future where they will have a different way of measuring success metrics for African fintech developers and solution providers, especially those that don't have the benefit of extreme access to Silicon Valley or any of the London investors and VCs. And the more we see VC capital coming from the continent, VCs run by Africans, I think we'll start to see really great numbers as that picture fills in.
Wonderful. And Governor, I'd love to continue with this theme. You talked a bit about regulatory sandboxes, but as we think about access to venture capital, is there a role for the government that you see here as well?
Yes, the bottom line is that if we allow orderly behavior in the marketplace, if you create appropriate incentives and even the rules of the game, then we are going to see the market developing. I've seen some comments coming in talking about digital lending in Kenya in the way, I think last week there was a headline that 14 million Kenyans have been blacklisted by the CRBs. But what I actually said, are you surprised? I'm not surprised. Nick, I don't know whether you know, I talked about this one time, because I argued that if you don't control the betting, online betting, and you also don't control the apps that are lending you money to go for online betting, it is going to be a mess. Anytime you don't have appropriate regulations in the marketplace, obviously the market will develop in a very diverse way. Then it means that, no, let's say the Capital Markets Authority in Kenya was moving into developing and even coming up with fintechs and even regulating fintechs so that it can come up with venture capital firms that can be relied on. But obviously, the story is still going on that side. But I think at the micro level, then everybody is now just getting quite confused in terms of how market conduct and regulatory conduct is actually failing. You know, the paper that Nick mentioned, I argued that if we are going to have the development that we really require, is that we have to have a state capacity in this digital process. And one aspect of it is that you have to have very strong institutions that regulate, protect, and nudge the market towards the development areas. And that is where the venture capital is coming from, because it's going to be risky if anything goes wrong. On the other hand, we also want to make sure that other regulators understand what is happening, so that it's not really fast coordination. It's first of all to try and see that they have the capacity to understand where the market is going from. And that is the blueprint of what we really are looking for in terms of capacity, regulatory capability, regulatory capacity, and strong institutions to nudge the market in the desired path. And if need be, protect and regulate the market. You only protect when you feel that there are risks that cannot be surmounted. But protecting the market using the regulations that are there is very, very critical.
Thank you. I'd love to move, there's a somewhat related question in the chat about technological capabilities in Africa. So, and servers, cybersecurity, technical developers, all these technical capabilities needing advances in Africa. So I'd love to open it up to the panel here and say, A, do you grant the premise of that question and to what extent? And then B, what if we accept the premise of that question as true, what can be done to help make advances in cybersecurity, developers, those things across the African continent? And I think, Viola, you had sort of marked this one potentially. So why don't I start with you, if that's okay?
Yeah, I remember years ago, and I shouldn't be giving my age away, when the word interoperability drove every single conversation, when there was a misalignment in the bandwidth on radios during 9/11, 2001. That had to be resolved at both the state and the federal level here in the United States. Now, since then, and because of my background in disaster recovery as well, I have noticed that this is an area that has to be addressed, I think, through the lens of interoperability, again, because of the African Continental Free Trade Agreement, and because we have to be able to find a very rigorous blanket approach to begin with as to how to protect data, individuals, cyber attacks, which often are from the outside. And even from the internal standpoint, I know that Ovamba creates technology that builds audit movie clips of every transaction that goes across our platform. The way in which to deal with some of these disruptions that Africa will eventually face has to be not just continental, but each country. But if each country is going to develop this, there needs to be some sort of a consortium that supports that interoperability to make sure that it has some sort of passportability across the entire continent, both at separate industries, sectors, banking, everything. Is going to be quite the tapestry. I believe that the results and the best in practice for that, it's probably going to come from both academia and from tech innovation. Somebody asked earlier about whether or not the African continent from a trade perspective will be taking its cues from Europe. My first glib response was, about time Africa does it for themselves. Doesn't necessarily need to emulate what Europe does. But there are some things that Europe has done that we do need to pay attention to, especially in post-Brexit, especially as how we measure what is successful and what we do about protecting the technology and the disruptions to markets and supporting the policymakers who I think are going to be wrestling with this for quite a while. So I don't want to take up time. It's a great subject, could be an entire conference all on its own. It's just making sure that standards are applicable and make sense to the entire continent and each of those different zones, whether it's CIMAC or OHADA or as SADC, any of those. It's going to be complex.
Wonderful. Yeah, and we've got about 8 minutes left, so let's tick through some more of these and get to as many of these as we can. Kunle, there's a couple of questions in here for you, and I'll try and combine them because I think thematically they're very similar. One, if you could talk about the efficacy of alternative credit scoring for access to credit, and B, of course, address the question of bias in alternative credit scoring and AI. Oh, you're on mute, Kunle.
Yeah. So the efficacy is pretty good. I mean, I think if you look at what we're able to do with the combination of information, you think about figuring out whether people are likely to pay you back, right? Once they've taken one loan and two loans, you think, well, if you look at their lending history, that is probably the best predictor. But the big question is, right, you're going to lose your most money on your first loan, right? Because now you don't have any information about the consumer before they take their first loan. And here, what you want, of course, is to rely on other alternative information that you have about their use of their cell phone, their top-up behavior, and so on. And that can be highly predictive. And in fact, if you add that information to their lending history, it's even more predictive than just the lending history alone. So the point of the matter is that you can make very predictive models, and ultimately these models have to be accurate enough that you can make money, because the initial default rate of the first loan is high. So yes, you can predict. And as to bias, the populations that you're looking at are, you'd like to take the information at face value. You're looking at their cell phone or financial behavior, and you're trying not to inject, any unnecessary bias. I mean, the whole point of this is not, no AI researcher, develops models that are intentionally biased, right? The data that are driving those models might be biased, and you like to root that out. But you collect as much data as you can over as wide a population as you can, given that, of course, the users are willing to allow you to use their data to build these models. And of course, that has to do with regulatory infrastructure around the businesses that you're collecting data from. But once you have that data, you're trying to get as broad a population as possible and limit bias.
Kunle, I think this is why you were very smart in launching as a bank. We did the absolute opposite, but for similar reasons. That first risk with the first loan, when you don't have as much data, it's not like we're running around with 3 credit bureaus in all these countries on our continent. And that's one of the reasons why, and Laura, your question is brilliant. We chose not to look at these transactions or to look at finance from the standpoint of traditional credit risk models or even alternative. We look at risk in trade by putting inventory at the center of a decision for transaction. We removed the issues of non-repayability by using Sharia law to have physical and legal ownership of an asset as we service a customer with financial inclusion. And when we ran an extensive beta model in Central Africa, the one thing that was very interesting is the risk resurfaces its literally its ugly head somewhere around about the 4th and 5th transaction with a customer. In our portfolio, we have customers who are on their 9th transaction. This is amazing data to collect. And the risk changes as the comfort level and confidence occurs. But when you remove the ability for that customer to actually physically have the money, especially when you're not a bank and you can't pursue this stuff in a court, you now have a really great way of managing business performance, profit for that business, and you've got risk elements that can sit next to traditional credit scoring information, which is why partnering with these banks the way Migo has, and their alternative is simple APIs to get information. And then you take something like what Ovamba does with a SaaS-based trade product that runs end to end, we start to see ways in which to de-risk the entire continent, which should drive further investment.
Wonderful. All right, so we're about 3 minutes left. What I'd love to do is maybe turn to each of the panelists just to give us 30 seconds of closing remarks, takeaways, things that you want the audience to take from this session. And maybe Nick, I'll start with you.
Yeah, great. Thank you. Well, look, I've enjoyed the conversation. You know, some really big topics we touched on, and you know, we've not got enough time to do all of them justice, I think. But for me, look, I am an optimist. That, you know, I've you know, bear the scars of having sort of got 2 initiatives off the ground, and they are, you know, to excuse my French, but they're bloody hard to make work at scale, and we shouldn't lose sight of that end consumer. Think about the problems we're solving for that consumer, and use the technology to fix those problems. Don't get too carried away with the fabulous things that technology can do, because it's, you know, it's all about solving a problem for someone on the ground, and you know, we try to keep that first in our mind as we're building new products and services in East Africa.
Thank you. And then Kunle, if I could go to you next.
Sure. Thank you a lot for you know, inviting to be on the panel. It's been a, you know, very dynamic and interesting conversation. You know, I think, you know, the message to the audience is, you know, Africa is an exciting place to do business in the fintech space, and there's lots going on, and no matter where you look, it's going to be a different a challenge. You know, whether South Africa, you know, West Africa, or East Africa. But the key thing is there's lots of talented young people, the large number of developers. You know, I lost counts, you know, 700,000 developers across Africa who are interested in working in this space. So there's lots of talent. And what we need to do is to figure out how to harness that talent to come up with you know, African solutions to African problems.
Thank you. And Governor, love to hear any closing thoughts you have.
Hey, thank you. Thank you very much. And let me make 2 points. And then in Africa, let me say, entry into a market is a very difficult concept, especially when it is coming with new products that are digital based or technologically based. For you to succeed, there's a lot of fear. And that's why I used to always to defend the first mover advantage should always be defended, so that at least you know that it is going to move the market. And that's for us is very, very important. And that's how the success in some of the companies, that some of the fintechs that have come in have succeeded because of that. Of course, I saw a question from the audience talking about digital capability and the systems, cybersecurity and all that. And I actually said, but we did present, several words are coming up whenever you mention fintechs. You talk about regulatory sandbox, you talk about innovation hubs, you talk about accelerators. What are we really trying to do? It is their experimentation so that those products are purified by the time they get into the market. And then they can talk about incremental investment. Nick can talk about even how even transactions, a number of transactions were even limited, especially in Kenya on Friday afternoon. And they went on and managed to create such a versatile system that they could handle all manner of transactions at different levels. So it's an incremental thing. But the most important thing is that failing is a very serious curse. So if you succeed, then you can now continue with incremental investments that allows you to capture the market. And the moment you capture the market, then you're going to see more investments coming in with more versatility and even extensive coverage and extensive digital space. That is going to work very well. That is my take, because essentially we need to take small steps, perfect it, and then we can move to large scale. Thank you.
Thank you so much. And Viola, please close us out.
Thank you for that honor. And it was so good to be with everybody. I want to call everyone and be their friend. It seems to me that the more we understand challenges and problems and successfully innovate for them, the more impact that we're making to the evolution of human beings. The more of an underpinning we have from the fintech perspective, the better we will be as Africans doing global business and leading our own trajectory for growth. So it's exciting to see what we're doing, and the fourth industrial revolution is here. and it's not televised, it's on an app. So thank you.
Great. Well, thank you all to our panelists. It was wonderful to have you. Thank you for joining us very early in the day and late in the day for others. So thank you. And thank you so much to the audience and to the University of Michigan. Have a wonderful day.